Here to discuss that and possible bank regulation, Louisiana Senator and Finance Committee member Bill Cassidy. And yeah, there's a couple of words now that due diligence is a two-word term that is getting a lot of weight, but also duration risk, which we were just talking about with you, and how big the problem is. And that's what got SVB. And you wonder, is it a major overhang to what we're talking about and something to worry about? Is it the tip of the iceberg?
It could be the tip of the iceberg. You mentioned Social Security, the exchange I had with Secretary Yellen. They got a duration risk in Social Security. And just like it's now reported, the Fed had been telling SVB years ago that they had a duration risk. For 30 years, it's been said to the Social Security folks that there's a duration risk. And I think as long as the issue is over the horizon, oh, it's okay. It's someone else's problem. It's not my problem. And then it hits hard and everything crashes. Whether it's banks or whether it's Social Security, that has to be addressed.
Let's focus on the banks today, though, just because of the situation, what Wall Street is watching. Many of these bank stocks, these regional bank stocks, are still under pressure this morning, even after everything we've seen to this point. As someone who sits on the Finance Committee, as somebody who's watching this, do you think that we've contained the contagion or not?
Oh, we don't know that, right? Yeah. We don't know what the balance sheet is. Again, I'm a gastroenterologist, but I've learned about duration risk. You have a sense that a lot of bank presidents kind of were whistling past the graveyard of their duration risk. It's clearly caught up with SVB. Presumably others are at risk. Whether or not someone's stock is really at risk, I think really depends upon how they've managed this high interest rate environment.
Are we engendering more moral hazard again? And it comes home to roost. It seems like it's happening again, isn't it? Someone said that a capitalism without risk is like religion without sin. That if there's no downside, it doesn't work. It's like the federal government is always there to backstop us until it's impossible to do, I would think. Are we doing it again?
It seems as if there is encroaching moral hazard, or I should say expanding moral hazard. Because every time somebody is rescued from their sin, their investment sins, the Fed steps up. Now, what's the alternative? That's the challenge. Were we going to let a lot of very innovative tech companies, small startups, not be able to meet payroll and dispense that whole system? I think we can probably agree that would not be a good thing. As it turns out, they also bailed out a lot of folks who were personal depositors who had exceeded the $250,000 payroll. To your point, it is an expanding moral hazard.
But depositors are different than shareholders or bondholders in all of these issues. Do you think depositors should be protected, and is that the something that needs to be made explicit so that you don't continue to see money run out of regional banks?
Yes. Obviously, you see the rationale in order to preserve the strength of regional banks. Mm-hmm. Obviously. What makes it difficult is it papers over the sins of management. And management was told they had a duration risk. They didn't pay attention to it. They continued just whistling past the graveyard, and then it came crashing upon them.
When they had to sell, yeah.